Yeah, so the session is recording now, and the recordings will be available, I think, on your Quick Force portal. I'm not really sure on what portal it will be available, but it would be available for those who have missed out, or even in case you want to, come back and look into a few of the concepts or examples, etc. So the recording would be made available. Having said that, let us get into a few preliminary questions as to, I need people to be interactive. Please come up, talk, engage, so that I know that you're not sleeping, right? So the first question is, why have you selected this elective paper, financial statement analysis? Anyone? What is the reason for selecting this particular elective paper? You can text also, you can, yeah, I
Yeah.
can, yes.
Morning, sir.
Yes, sir. Good morning, sir. Hello.
Morning.
Yeah, this is Srikanth Reddy, sir.
Hi,
Yeah,
Shrikant.
yeah, sir. Sir, why financial statement analysis is like in stock market or anything like there is lot of companies, sir, in NSE and BSE. So to analyze the company, sir, like how the report balance sheet, like every year, how the company is getting like profit or loss. Doing particular analysis, I thought like financial statement analysis will help, sir, a lot to understand the things.
Good, Shrikant. Great. Anyone else? Any other thought
Sir,
process?
to analyze annual report of the company.
Great.
How exactly annual report should be analyzed? What are the criteria we need to focus? If
Okay.
even if we wanted to start our business, like many of them wanted to start their own business after a few years, so they can have little bit idea on how what areas we need to mainly focus. If we do this, what a profit we'll be having. That would be also helpful for us.
Very good and apt and to the point.
Sir, to know the financial position of the company.
Very good. Okay. Okay. It's also
So,
interesting.
So, since the financial statements tell us a lot about the company, how their valuations, I mean, other their value, the assets and liabilities. So, definitely analyzing these statements would be helping everybody outside the company, the stakeholders, to understand how the company is working, basically.
Absolutely right. Bang on.
Good morning, sir. I'm Pratyush.
Morning.
So, from an entrepreneur's point of view, we can analyze the financial statements and take future decisions based on these analysis.
Great. So the various answers we've received till now is, I'm going to be an entrepreneur. I want to know the basics of financial statement analysis. I am interested in the stock market. I want to know how the various listed companies, we have roughly around 12,000 or 13,000 listed companies in India. Whichever company I want to look into, how are those companies performing in terms of their profit and loss. One of the student also mentioned a particular terminology called as the financial position of a particular company. That's right. And all answers are absolutely right. But why financial statement analysis for a MBA graduate when it is pretty much the domain of a commerce graduate like a CA, CS, an accountant, or a cost accountant? Why is it that an MBA needs to know what a few certain aspects of financial statements, certain aspects of marketing, certain aspects of sales, procurement, etc.? Why is it that an MBA is required to know bits and pieces of multiple things? Anyone?
So, because he has to manage the whole business.
So, to interpret the like to interpret
A
those
manager
statements.
is required to make informed decisions about any department he is managing or being a part of, and consulting or analyzing certain aspects of the company, like their financial statements, also adds as a very important attribute to this job. So I think that is why it is important.
Great, great. All right. Thank you. Thank you. So on that particular note, I'm very glad that all of you know and you have all made an informed decision of selecting this particular topic. It is very important for you as a manager, irrespective of the role that you take up an element of finance, an element of commerce, an element of numericals is always involved in your job. It could be numbers in relation to sales. It could be numbers in relation to payroll cost. It could be numbers in relation to certain fixed assets that you're overlooking, right? Everything forms part of financial statement analysis. While the name of the topic is a broad name like financial statement analysis, since all of you know the contents of the financial statements are various aspects of accounting, we will also be required as a manager to look into each of these aspects and how they function in respect to the organization that you'll be joining in the future, right? And that's just an internal use. And of course, like a couple of them mentioned, there are various other uses as well of financial statement analysis. All right. Okay. Which is the most widely spoken language in India? Chat box, please.
Accounting, sir.
Widely spoken language in India?
Sir, Hindi and English.
Hindi and English, okay. Great. So similarly, like one of you mentioned, the widely spoken language of business is accounting. Can you tell me which is the second most widely spoken language of business other than accounting?
Economy.
Economics.
Correct. Any other guesses?
Finance.
Okay. What else can it be?
Balance sheet.
Balance sheet. Good.
P&L.
P&L. Okay.
Sir, cash flow.
Sir, financial statements.
Okay. Anything other than financial statements?
So valuation of the company.
Very good. Valuation of a company. Okay. Sorry?
Annual report.
Okay. Annual report, financial statements. Okay. Anything other than that? Markets is what I see in the chat box. Good. Apart from the internally generated information, we also have various reports that are generated by analysts. There are various reports that are a result of a particular research undertaking, right? There could be various statistics about a particular company. There could be various comparisons about a particular company. All these are slightly external to a company, but then they give you an ocean of information about the company as well, which will be over and above what a financial statement can offer. Of course, your financial statements, of course, your accounting are the preliminary or the basic way of conveying what the business is doing, how the business is doing, and what potential it has in the future. We all know that enough has been said about it, and all of us know that these are the primary documents. But over and above that, we also have various other sources which are important to get sort of a holistic view of a particular business. All right. Okay, let's, like I said, we have gone through various aspects of business, various aspects of accounting already in the first semester. Couple of questions again. Is doing business simple? If the answer to this particular question is no, then can you put any reasons in the chat box, please? If you think it is no. Competition. That's right. Competition makes it difficult. Okay. Risk is involved. Capital requirement. Network. You mean to say customers. Okay. Vendors. Skill sets required. Goodwill required. Very good. State of the economic market. Absolutely. This is something which is sort of relevant now. Capital again. All right, great. So there are, of course, why I asked you in the first place is doing business simple? And the answer, yes, would be absolutely wrong. because any simple kind of business requires an elaborate process of planning. It requires certain estimations, it requires certain coordinations with the vendors, customers, etc. However small business you are doing, if you are a small vendor on a street selling some fruits, or if you're selling some mobile accessories in the form of a temporary kiosk, even then you need to know various elements of business which could be complex at a point in time, right? So business, is it only about making money? Again, the answer is no. There are various things that a businessman will have to keep in his mind. It could be, of course, customer comes first. Customer is the king. Many business authors, many business prodigies have actually proved that without a customer, nothing can happen. So customer centric businesses is something which makes a business viable. Of course, profits are necessary. Of course, a positive cash flow from operating activities is necessary. But there are various other things other than just money. It is the quality of relationship, it is the quality of the product, and it is the kind of ethical practices that a particular business follows. There are different forms of organizations. There are different ways in which businesses can be set up in India. One of the very commonly found structure of a business organization is called as a company structure, wherein you either can have a listed company, which is of course a public company, or you can have a public unlisted company, or you can have a private limited company. And finally, you have a new category of company called as a one-person company, which is pretty much a new concept, which is barely some 3 or 4 years old. So 4 different types of companies are possible in India. Apart from the company kind of structure, we also have different forms like LLP, that is limited liability partnership. We have general partnership. We have a sole proprietary firm. We have various other forms such as trust, societies, HUF, etc., etc. So all these forms of organizations, while a majority of them are best suited for a commercial purpose, for a commercial intent, there are only a couple of these options that are suited for a charitable purpose, religious purpose, or any philanthropic purpose. So the subject matter of this particular discussion of financial statement analysis will be purely restricted to that of a company with real life examples of listed companies. Of course, once we understand how the financial statements of something as huge as a company can be analyzed, then analyzing the financial statements of lesser complex structures like LLP, lesser complex structures like a sole proprietary firms becomes like a cakewalk. So that is the reason why we will be looking at various examples only from the point of view of a company, and the rest of the organizations, understanding of the financial statements of the remaining kind of organizations becomes very simple. All right. The final question is, why should one know what are financial statements? Before we discuss deeper into this particular question, I will park this aside for the time being. Let's move forward. Okay, what are financial statements? Of course, the idea is to convey various parts of this particular subject in a conceptual manner with the help of examples, because we are not looking for theory. We are not really looking for definitions. Those are something that are there as a part of your textbooks, reference materials, etc. But let's first focus on understanding the concepts. Of course, it looks like 80% of the audience already know what a financial statement is, but for the benefit of others, I'll explain what a financial statement is. So if you want to know about a person, say if you want to know about me, Professor Shravan, then you can look into my LinkedIn profile, you can look into my resume, or you can look into a person's Twitter account, Facebook, etc. if you want to know about a person. So similarly, if you want to know about a business, the go-to destination or the go-to point for you would be to look into the financial statements. This is pretty much like a horoscope combined with the resume of a company, right? It is not just about what has transpired till now, but also about what it is capable of in the future. That's why I said pretty much like a horoscope of the company. Financial statements discuss the as is position as well as the could be position, right? So there are various components of a financial statements. Of course, there are regulatory requirements which say that these are the minimum mandatory number of inclusions in a financial statement, which could be your balance sheet, the statement of profit and loss, it could be your cash flows, etc. But there are various other elements which can be added into a financial statement, which will be termed as a part of the annual report of a company. This could be MDNA, that is management discussion and analysis. This could be the SWOT analysis of the company. This could be about the management of the company. This could be various things, right? The vision statement, how and certain KPIs, key performance indicators. This is the total sales that I have done sector wise. This is the total employees that I have. This is what is forming a part of my human capital. There could be various other aspects which are necessary to give information to the various users, but there are certain mandatory portions of this which will generally comprise under the broad heading called as financial statements. Do you get me? Under the annual report, the subset of an annual report is your financial statements, because financial statements are primarily something which is required to be presented. In most of the situations, it's a mandatory requirement for the entities to be presented. Since we are talking about companies, all the companies will have to go through the mandatory presentation of their financial information in the form of financial statements. All right. Okay, why are financial statements required? We already have gone through this particular slide where many of the students have already given you various views about the same. But let us look at it in a structured manner for the benefit of all the other students. First and foremost, importance of financial statements is that it provides the necessary information to a host of users. Who are the users of financial statements we will dwell upon shortly as we proceed forward in the presentation. But for the time being, understand that there are various users. It could be your customer, it could be without intention, it could be your competitor, because intendingly no one wants to give away information for competitors, right? Competitors are also one of the users, but that is an unintentional user. That so much so there has always been a hue and cry about the amount of information that is mandated to be given in a financial statement, because many businesses fear losing certain critical aspects or certain secrets of their particular company in the name of mandatory disclosures in the financial statements. So that's always a conflict that is there in the real life businesses. But having said that, there are various users. All right. So we also discussed that the future of a business can be predicted. So when I say future of the business, is the business making continuous losses? Is the business continuously failing to repay its loans? Is the business continuously not able to serve its creditors, serve its employees? The employees have not been paid from the past 6 months. These kind of negative observations can be very easily be identified from the financial statements, along with positive identifications such as a very good turnover, a very good net worth, a very huge asset base, a very good set of investments made by the company, the very good set of employees, very good set of directors on the board of the company, both independent directors and whole-time directors, who bring with them a host of experience, which is very relevant for the business under discussion. So there are various ways to predict the future, whether the future is going to be positive, negative. easily one can identify with the help of a financial statements, provided the financial statements have been aptly, correctly, legally, logically prepared, right? The next thing is the economic position and economic performance. One of you mentioned about financial position. So the financial position of a company can be said by looking into the balance sheet of the company. So the balance sheet, as you all know, comprises of assets, liabilities, capital, both internal as well as borrowed capital, and various other aspects like contingent liabilities, which are off the balance sheet, etc. So on a particular day, where do I stand? How much of assets do I have? How much of debtors and inventory do I have? Do I have 10 crores worth of finished goods? That means I'm capable of selling them if there is a market for it. All this kind of information will be available from the balance sheet, which will tell me the economic position, in other words, the financial position of a company. Whereas the financial performance or the economic performance is something which is identified through the statement of profit and loss account. Statement of profit and loss account, as you all know, again, primarily also can be called as an income statement, which will show the various sales that are done by the company. It could be in relation to trading, manufacturing, services, etc. And you can also identify the various expenses that the company is having, right? This is very basic. All of you already know it. So this is one of the main reasons why financial statements are required. Liquidity and solvency position. These two terminologies are oceans apart when it comes to their meaning. Liquidity is something wherein we try and identify whether the company's assets are in the form of liquid assets or are they in the form of illiquid assets. So what are liquid assets? Liquid assets are those which can be converted into cash easily, immediately, to meet the various requirements. This could be your fixed asset. I'm sorry, this could be your fixed deposit balances. Is there a question?
No, sir.
Yeah. So this could be your fixed deposit balances, which can be canceled immediately. This could be your bank balances. This could be your short-term investments. Short-term investments could be, say, for example, an investment into a debt instrument. It could be a mutual fund, right? All these are liquid investments. What are illiquid investments? Illiquid investments are primarily those on which your business depends upon for the long-term business generation. It could be your fixed assets, because fixed assets you do not buy with the intention of selling, right? So fixed assets like machinery, furniture, land and building, all this is something which is not so easily possible to sell them. It's not easily possible to liquidate them to meet the various requirements of the company. So how liquid is the company, how illiquid is the company, is something your financial statements can give information about. And solvency position, how solvent are you? What is the meaning of solvency? Solvency means you have 100 rupees liability towards a creditor, but you have assets worth only 80 rupees. So there is a shortfall of 20 rupees. Are you solvent? The answer could be yes as well as a no. The answer most of the students could think straight away is that you are insolvent, because there is a 20 rupees gap or a 20 rupees shortage when it comes to the availability of the assets to pay the liabilities. But the solvency position is something which needs to be seen not always on a particular date, but also on the various qualitative factors, like is the company having capacity to generate more assets in the near future, with the help of which I can service my liabilities, with the help of which I can pay my uh, bank loans, or I can whatever commitment I have with any kind of a lender. So solvency position is something which needs to be seen on a case-to-case basis. In case, on the basis of assessment of the qualitative factors, quantitative factors, it can be assessed that you are an insolvent company. then the laws, be it your Companies Act, be it your SEBI, be it your various other regulatory authorities like RBI, have got various mechanisms to address a situation like this. In case you are insolvent, there is a separate code itself that has been bought in India just a few years back called as the Insolvency and Bankruptcy Code, wherein a business will be taken through the process of revival. And in case the revival doesn't happen by way of changing the management, by way of changing the owners, etc., in case the revival doesn't happen, the ultimate conclusion would be that of a closure or a dissolution or a liquidation of a company by selling all its assets. Finally, another important aspect of why financial statements are required is to understand the management capability. So, who is the management of a company? The management comprises of the board of directors. It comprises of the senior officials in an organization who are pretty much the people who take strategic decisions. They call shots, right? So they decide what product needs to be sold, what product needs to be discontinued. They decide which new geographical area has to be explored when it comes to starting the business or expanding the wings of the existing business. They can also decide who is the major vendor from whom we need to procure, and what kind of technology innovation has to be taken up, what kind of research needs to be taken up, especially if you're in a field like, say, pharmaceutical company, etc., which is a strategic location to buy a land, say if you're in the business of real estate construction, right? So these kind of decisions are directly proportionate to the capability of the management, the strong analytical as well as decision making powers of the management is what makes a company prosper, because it is not the employees who take decisions, it is not the employees who run the business, the people who run the show are the management. So by looking at the financial statements, we can also know how capable the management is. The various important elements of financial statements, again, I'll not spend much time over here. Assets are those items which are capable of generating future revenue, future cash flows to a organization, to a company. Something which has a useful life of more than 1 year will be considered as an asset. Liabilities, again, as the name itself says, are those where the company owe an amount of money to certain parties. It could be internal parties like, say, director loans. It could be external parties like, say, loans from banking institutions. It could be operational parties like your creditors, from whom you have purchased some materials or taken some services, etc. So equity is, in other words, nothing but the capital of a particular company. Any particular business organization needs certain basic capital to start a business, right? So this could be in the form of equity share capital, preference share capital. I'm sure all of you have gone through these kind of terminologies in your first semester already. Revenues and expenses, we have already discussed. Revenues are nothing but the sales of an organization, be it from the materials or services. And expenses are a host of expenses, be it direct or indirect expenses. Direct expenses are something which are directly attributable to enabling the sales, whereas indirect expenses are pretty much like your overheads, which are compulsory, which are fixed in nature and not variable. These direct expenses are variable, whereas indirect expenses are generally fixed in nature, which needs to be incurred irrespective of the volume of sales, right? And the resultant figure of your revenues and expenses could be a gain, could be a loss. And these gains and losses have different kinds. Again, these losses could be segment wise, or these gains could be geographical location wise, etc. All right, so at this point, let's just I think the attendance is opened up. Go back to your quick force pages. Kindly mark your attendance for the first session. I'll just give a minute or two for this purpose. I repeat, go to your quick force and mark your attendance. The attendance is open only for 5 minutes. Please mark your attendance. I'll just wait for a minute.
Sir, how do I mark my attendance?
So what you have to do is do you see the subject financial statement analysis on your dashboard?
Yes, sir.
Once you click that, you will find a host of materials that have been attached, and one of the links says attendance. So you just have to click.
So there's a link and there's also a box beside the link. So should I tick the box?
That's right. So there are 3 different boxes. One is present, one is late, and the other is absent. In case you don't mark the attendance in the first 5 minutes, the present will go and only late will come. And in case if you don't mark the late in the next 5 minutes, it will automatically consider as absent. All right, looks like most of you have marked your attendance. Let's get back to our presentation. Let's look into who are the different users of financial statements. We discussed about internal and external users and at a very, very broad level before, right? So let's take a deeper dive into who these users can be, right? So I think there is some chat. Okay. Okay, if you're done with the attendance, yeah, thank you. Okay. All right, so the first and foremost important user of a financial statement are the internal parties, such as the shareholders or the investors. So shareholders or investors are a set of people who have invested money so that the business can run. It could be in the form of a seed capital. It could be in the form of further investment to enable expansion, growth of a business, growth of an organization, diversification, etc. The reasons for capital infusion could be manifold, and it's obvious and logical that if a person has given money, if he has invested money into a particular business, he would have obviously invested with the intention of getting some returns from that particular business, and he would also want to, in the process, understand the progress of the company, how well or how bad the company is doing. That's why looking into the financial statements is pretty much the prerogative of shareholders and investors. It becomes all the more complicated if the stakes or the investment percentages of these shareholders or investors is on the higher side. Say, for example, if I'm just holding one share in a company like Infosys, then my worry about how the company is performing could be much lower when it compares to a person who is holding 1% of Infosys or 5% of Infosys, right? So it is directly proportionate to how much of skin in the game you have. All right. So the second important user of a financial statement is your internal persons, again, management and directors. Management, as well as the directors, the senior officials, need to get relevant information. If I get an information about the kind of assets that I have, about the kind of sales that I have made, which is a stale information as in this information I have got like 1 month back data, it's of no use for me. I need to get relevant information, real-time information, and quickly, and necessary information, and not data. You all know the difference between data and information, right? So I need to get relevant data, which is the relevant information, so that I will be in a position to make any kind of decisions, call any kind of shots, right? So that is the reason why financial statements are required, even for the directors or the management of a particular company. Next is lenders. As you can see on your screens, I have put a couple of examples over here. All of you must have heard about the famous scandal or the famous case way back in 2008 or 9. I'm not really sure if you've heard, but there was this company called as Satyam. So it did a lot of manipulation in its financial statements. Yes. So Satyam has become famous because it has been a subject matter. It has been a case study in various scenarios. So what Satyam did, Satyam of course was a listed company. One of the mastermind behind all this manipulations was the company's senior management itself, the board of directors itself. So what they ended up doing was like a host of manipulations, host of unethical practices. So what did they do? They cooked up the books, showed fictitious employees, they showed fictitious fixed deposits and cash balances, they showed fictitious revenues, or they adopted really fancy policies which will enable them to speeden up or accelerate the process of recognition of revenue instead of postponing them to the future periods, right? So there were various other things that these people did. And of course, there are various findings, various studies about this. How did this happen? How did this not get identified by the auditors, internal or external, etc., etc. And also, given the fact that it was a listed company, how did SEBI not find it? How did many people miss out on this? Because these kind of manipulations were happening for multiple years, right? So these kind of case studies we will look into as we move forward, but for the time being, just understand that lenders need to understand how correctly the financial statements have been prepared. Of course, the comfort on a financial statement is generally given by the auditor, who audits the financial statements and gives his opinion in a report called as the auditor's report. The auditor, if he is satisfied about the fair presentation of the numbers in the financial statements, a fair disclosure of the operations in the financial statements, then the auditor will give a report which is called as a clean report. The auditor does not have any kind of objections. But in case the auditor has certain objections, considering various other factors like materiality, impact on the numbers, etc., then he can put in his observations in an audit report in the form of qualifications, in the form of disclaimers, modified opinions we call it as. It could be a disclaimer, it could be an emphasis of matter, etc. Don't worry, for the time being, just understand that these are the various components of audit report. As time comes, we will develop on deeper into this. But why I am mentioning that to you right now is the lenders, of course, rely upon the financial statements which have been audited mandatorily by an auditor, just to give that first level of comfort. And they will be in a position to identify the credit worthiness of the company. Is the company capable of repaying the loans that I have given? Is the company capable of asking me for a higher loan in the future or right now? Or what the issues the company is facing. If the company is continuously having a negative net margin, are the shareholders interested in the business? Are they capable of funding? What kind of security do I have for the loan that I have given? If I have given a loan for a particular asset, is that against a particular asset as a security, is that asset still there in the financial statements, right? So there are various things that I would be interested in looking into the financial statements for. The next important user is the suppliers or the creditors. So suppliers and creditors, you might be wondering, these people just are people from whom I buy certain items from them. How are they bothered? As long as the company is paying these people on a timely basis, why should these people be bothered about what are there in the notes to accounts, what is there in the annual report, etc., etc. The only thing that they need to bother about is the statement of profit and loss account. Is the company making proper is it generating proper revenues? Is it yielding a good amount of profits? That is something that they need to be bothered about. So it is not necessary that all users will be bothered about every part of a financial statement, right? There would be certain aspects in the financial statements which would be required by them to look into, which they find it as important for their purposes of decision making. Next is employees. Employees could be different employees. It could be your past employee, because the company would have given something called as a retirement benefits. I retired at the age of 60. I'm 62 right now. I'm still continuing to get something called as a pension from the company. I would be interested in looking into the financial statements of the company even after I have retired, because I want to know the pension paying capability of that particular company. Tomorrow, if the company winds up or turns out to be insolvent, then I stand to lose. So even I am an interested party, right? Present employees, of course, needless to say, they would like to know about the going concern element of the company in case of difficult times, say like this pandemic or any other difficult situation, how well the company is coping up with these kind of adversities, these kind of challenges. Is the company is able to still sail its boat or not? So that's what the employees would be interested in knowing, because it's pretty much their livelihood, right? They are trying to earn their bread and butter. Without the company, they might have to look for other opportunities. So present employees find it very important. Potential employees, if I want to join a company, then I would of course want to do give a basic look into the financial statements. Is it capable of paying salaries on time? Is this company famous for not paying the salaries on time? How is the work environment? How do they treat employees? What is the work culture? So financial statements, like I said already before, as a part of the annual report, you will find a lot of non-quantitative, in other words, qualitative aspects also, right? While financial statements primarily is the quantitative aspects, but one would be interested as an employee to look into the annual report also, to look into the work culture, work ethics, etc. Next is customers. Of course, customers would want to know whether they can continuously buy a particular kind of item from your company, right? Say I'm a customer who is buying one of the major components in my business from your company, and your company pretty much is the only company which is giving me a qualitative product. I would be interested in looking into your financial statements to understand how good you are doing, because tomorrow if you shut shop, I do not have anyone else to buy this component. It is a domino effect, right? So if you shut shop, I do not have someone else who can provide me the same kind of raw material or the same kind of service, then it will be difficult for me. So that is why customers also would be interested, depending upon their level of transactions. Of course, if I'm a huge customer, then I would be all the more interested into the financial statements. Next is the obvious, government and other regulatory authorities. Since we are talking about companies, the companies are governed by the Ministry of Corporate Affairs, and the law that governs companies is called as the Companies Act primarily. So the Companies Act has mandated various things to be a part of the financial statements, including the form and content of the financial statements, what needs to be present, how it has to be presented, what is mandatory, what is not mandatory. And all this forms a part of a ministry, a central ministry called as the Ministry of Corporate Affairs, right? So this falls under the finance ministry portfolio generally. The next authority could be your direct and indirect taxes related authorities, that is the Central Board of Direct Taxes and Central Board of Indirect Taxes and Customs. So obviously GST authorities and income tax authorities would want to look at the financial statements, because they want to identify whether the taxes that are due to them have been paid and calculated appropriately. Auditors, we've already discussed before. Since audit is a mandatory requirement under the Companies Act, it would be necessary for an auditor to look into the financial statements, audit them, ask several questions, suggest various changes in the disclosure, presentation, measurement of a particular item in the financial statements, and also tell the management about how they can improve upon their reporting procedures, various things that the auditors also, while being independent, can add value to a business. And they are one of the primary users of the financial statements. And apart from these 8 categories, there are a host of other users of financial statements. It could be your general public, it could be a person who's doing a research. Say, for example, you must have heard of your CIBIL and various credit rating agencies, right? So it is the job of these agencies to look into specific companies, and depending upon various parameters, they will be capable of grading these companies. That is one. These entities are also one of the users of financial statements. And there could be certain investment houses, investment advisory houses. Say, for example, I have certain amount of money and I do not have the financial literacy of studying the financial statements, then I would approach a consultancy company which is capable of analyzing the financial statements of various companies and advise me which is a right company where I can put my money in the form of an investment, right? So these kind of independent parties who are called as analysts or who are called as research teams or consulting companies, investment advisors, etc., they are also one of the very important users of financial statements, falling as a part of your capital market ecosystem. All right. Okay. We have all understood that accounting is the language of business. This is the way one can identify what is happening in a business. We have all discussed about this particular fact, but does it have any rules? Just like I speak English, there are certain grammar rules, there are certain sentence
Yes, sir.
formation
Accounts
rules.
has rules.
Can anyone tell me what these rules are?
There are total 3 golden rules of accounting, sir.
Okay.
So, yeah, one being the debit the receiver, credit the giver, debit what comes in, credit what goes out, and debit all in losses and expenses, and credit all incomes and gains.
Great.
Personal account, real account, nominal
And nominal account, yes, sir.
Absolutely. So these are called as the golden rules of accounting. But are there any other rules other than these 3 golden rules which are necessary?
Maybe going concern is one rule where
Absolutely.
even after the owner is not there anymore with the company still goes on. So that is one.
Okay.
Business entity, sir.
Shivam says gap. Okay. Okay.
Sir, accounting standards.
Very good. Okay. Anyone else? All right. So many of you have given various different rules which are mandatory, necessary for an accounting to speak what it really means, what it really is in the form of a structured financial information. So what could they be? They could all be bucketed into different headings, different broad categories, which we call them as assumptions. It could be standards, accounting standards. It could be accounting policies. It could be accounting principles, conventions. Conventions are nothing but the various practices that I follow and preach, right? So these are the various rules that are there. Again, all these at a very broad level, you have already understood, and you need to remember and recollect your understanding about these various concepts. Of course, one of the students mentioned gap. Gap, we are going to talk about the generally accepted accounting principles and policies in detail in our next week's session. But in this week's session, let us broadly understand what these various things are. Very quickly, assumptions, in other words, the accounting assumptions. There are 3 fundamental accounting assumptions, which we call it as consistency, accrual, and going concern. We remember it as CAG, right? Consistency, which means that the kind of policies, the kind of principles that I follow have to be followed on a consistent basis year on year. That is what is called as consistency. What is accrual? Accrual is a concept which is very different from a cash system of accounting, which says that I need to accrue or foresee or account for all expenses, irrespective of whether they have been paid or not. When there is an obligation to pay a liability, then I need to accrue for them. Similarly, if there is a right for me to receive an amount of money in the form of revenue, in the form of sales realization, then I can accrue for the revenue provided the conditions are satisfied, right? And the final assumption is a going concern. So what is going concern? All of us, all the business entities prepare their financial statements assuming that the company will run its business into the foreseeable future. In case this particular assumption is not holding good, then I'll have to disclose in the financial statement. So these are three important assumptions which are called as the fundamental accounting assumptions. Next, we have principles. All right. So what are accounting principles? One might always get confused between what is an accounting principle, what is an accounting policy, what is an accounting standard, why so many are required, why can't we just combine everything and put them together, right? So let me give you an example. Okay, when you're going on a road, is there a question? I can hear some sound. All right. So when you're going on your road, there could be a signboard which says go north to, say, for example, reach Indranagar in Bangalore, right? If you go north, you'll reach Indranagar. Let's assume for the time being that this particular signboard on the road is an accounting principle. It is telling you how you should go to reach your destination. But how you are actually going? Are you going by walk? Are you going in your car? Or are you going in a bus? It's an option that is there for you, right? To meet that principle, to meet that accounting principle. So going in the bus is an accounting policy. Going by walk is another accounting policy. And choosing to go in your car is another accounting policy. So what I'm trying to say is the objective of an accounting principle can be served through various policies which can be chosen by a company. If I have to give an example, the accounting principle says you have to charge depreciation on your fixed assets. I'm going to take a very small example. That's why I'm taking depreciation. I can either choose a WDV method, that is going by walk. I can either choose a straight line method, which is going in the bus, right? So within this particular framework, there are certain options that are given to me, which are called as accounting policies. But let's say I want to go to Indranagar, but I will go in a ship or a boat. That's not possible, right? So what I'm trying to say is accounting policies are something one needs to choose within the acceptable framework of the accounting principles of accounting language. Okay, if I want to choose a ship to reach Indranagar, that is not a part of the acceptable accounting framework, right? So while there is an element of choice that is available to me to reach my destination, I cannot choose something which is outside the accounting framework, which is going in a boat or going in a ship. But what are accounting standards? Accounting principles are something which guide an accountant on a day-to-day basis as to how accounting has to be done, whereas accounting standards are primarily and directly related to the financial statements itself. It could be about measurement of a particular item in your financial statement. At what value should I recognize my fixed asset? At what value should I recognize my liability? Or what value should I recognize the contingent liability as? It is also about presentation and disclosure. If I am giving a particular value of a sale, say for example, export of clothes, and in relation to this, what are all the disclosures that I have to give in the apparel manufacturing company? I'll have to disclose these are all the raw materials that were used. This is how the consumption pattern was, etc., etc. These are all the countries to which I have exported, and this is the segment-wise reporting of my revenue, etc., etc. So there are various presentation disclosure aspects that one needs to follow, which is pretty much the fallout of the accounting standards. I hope I've been able to clear the various concepts to you. Any doubts at this point, please?
No, sir.
All right. Fundamental accounting assumptions we already discussed, C and A and G, consistency, accrual, and going concern. Okay, I gave an example of depreciation already. Let's see what are the other areas where there is a room for me to select if I can travel in a two-wheeler or if I can travel in a bus, right? One of the area is conversion or translation of foreign currency items. It could be policy chosen by the company that I'll try to keep this example simple. If I am purchasing something, if I'm importing something from a foreign vendor, let's assume I am importing something from the USA, some machinery, it could be the policy of the company to consider an exchange ratio, exchange value of USD to INR as on the date of transaction or the average rate that is applicable for a particular month. It could be from RBI website, it could be from SBI website, etc. So it is a policy that I choose. There could be, say, for example, import of automobile components on a daily basis. If I'm, say, Maruti Suzuki, I'll have multiple imports. Of course, I'll also have multiple local purchases, indigenous purchases. There could be multiple imports which are not locally possible to procure. And every day I have purchases. So it could be the policy of Maruti Suzuki that whatever is the average rate of USD on a monthly basis, I will consider the same USD rate for accounting the expenses, accounting the imports in my books for all the import transactions in a particular month. Or they can also say, I will recognize them at individual transaction USD conversion rate itself. Okay, that's one area where different accounting policies are possible. Valuation of inventories, most of you know already, first in, first out method. LIFO is the theoretical method. That is last in, first out is a very theoretical method. It is not allowed. Sorry, is there a question? Yeah, so it's called as LIFO, FIFO, weighted average method, etc. These are different ways in which you can measure and recognize your inventory in the books of accounts. While the cost formula is the same, that is your cost or net realizable value, NRV, whichever is lower. There you do not have an option. Every company has to follow cost or NRV, whichever is lower. But in relation to the method that you choose for the purpose of identifying the flow of inventory usage or dispatch, FIFO is possible, weighted average is possible, LIFO is specifically not allowed. Capitalization of fixed assets. I can capitalize fixed assets and recognize them in my subsequent balance sheets at the historical cost method, that is the purchase cost itself, or I can choose to have a revaluation model where on every balance sheet date, I'll end up revaluing my fixed assets, which I feel is more beneficial. It's an option that is given to me by the accounting standards, right? So it's a policy that I follow. Mind you, whatever is the option that is given to a company, that is an accounting policy that you're choosing, has to be specifically be disclosed in your financial statements as a part of notes to accounts. We will see when we look into a real life scenario of a financial statements. I'll try and link each and every aspect that we went through in the last 1 hour into the annual report, so you'll understand. Valuation of fixed assets, we already discussed. Treatment of contingent liabilities. What are contingent liabilities? Contingent liabilities are those liabilities where there is a possible outflow of money. It is not confirmed as yet that I will have to pay a certain amount of money to fulfill the liability, to close the liability, but there could be a situation that I have to pay. Say, for example, there is a court case. One of the major customer has filed a case against me, that is, I am the company, because of a certain defect in the product that I have sold to him and for which I'm not ready to reimburse. So he has taken this particular case to the court. So in the court, if the proceedings are still going on, and as on the balance sheet date, let's assume 31st March 21, this court case is not yet concluded. So I do not know if I end up paying certain amount to him towards the damages, or I don't have to pay anything. It depends upon the court's verdict, which I still don't know. So in such a case, what one needs to do is he needs to look into the possibility of paying. and recognize that amount as a liability in the books of accounts. And this is considered as an off-balance sheet item. Contingent liabilities are off-balance sheet items. That is, they are since the concrete liability or an established liability is not yet made, it will be considered as only a disclosure in your notes to accounts. And how you treat these accounting liabilities is something, again, a subject matter of a practice, a subject matter of an accounting policy, subjected to the guidelines in your accounting standard. AS 29 talks about various ways or conditions in relation to recognition and treatment of contingent liabilities. Okay, consideration and selection of accounting policies. Before this, I think we're just 5 minutes away from having a break. Let's just look into few poll questions. I just need all of you to participate in the polls. These are something. Can you see the poll?
No, sir.
No, not yet.
No, sir.
No, sir.
Okay.
Can you
Yes, sir.
see?
Now we got.
Sir, you can.
Yeah. Can we be a bit quick in these questions?
Sir, only one question.
No, there are few more. I will bring them up one after the other. Looks like there is a very evenly distributed opinion between customers and capital. Like we discussed, the focal point of any particular business first and foremost would be the customers. Of course, it's a chicken and egg situation of without capital, I'll not get a customer, and without customer, I will not be able to generate the necessary required capital for me to proceed with the company. But if you have to choose only one answer for this particular question, the answer would be customers. Okay, because still a business can run on the basis of credit, right? I can buy something with a 30 days credit period, and I can sell something with cash and carry today itself and generate money from the customers and use that money to pay to the vendors, right? So that way you can still run a business without immediate capital, but you cannot run any kind of business without customers. So the final answer for this would be customers. Next question. Can you see the question?
Yes, sir.
Yes,
Yes,
sir.
sir.
That's absolutely right. Business organizations are nothing but cash machines with lags in receiving and paying cash, because it's not always necessary, or it is very um, um, lesser number of situations where businesses are all the time cash and carry. There will always be some or the other element of credit in any kind of business. So A is the right answer. Next question. The right answer over here is actually the controller. You should know the difference between a controller and a CFO in an organization, which is pretty much a part of the finance and accounts hierarchy in the organizational structure. So you have an accountant, you have a manager who is called as a controller, and the controller finally ends up reporting to the CFO. CFO reports to the board of directors. That's how the structure works. So the primary responsibility for maintenance of accounting is in the hands of a controller, because a CFO is a person who is broadly looking at various aspects of accounting, including taxation, including budgeting, including procurement, etc. It is the controller who has the first hand responsibility of maintenance of the accounting records. The final question before we break. The answer is absolutely right. It's mandatory not only for companies, but also for other forms of organizations, depending upon their regulatory structure. So the answer is B, false. All right, so we will take a break over here. I'm told we are supposed to reassemble at 10:25. There are a couple of questions in the chat box. I will take them as soon as we are back. Okay.
Thank you, sir.
Yes, sir. Thank you, sir.
All right, welcome back, everyone.
Yes, sir.
Yeah, so
Yes,
there's
sir.
another question on your screens.
Yes, sir, have done.
Sure.
Done, sir.
So while resolving labor disputes, yes, is the right answer, but in few cases, trade unions and labor organizations can also use financial statements. So sometimes there would be a lack of clarity in the kind of questions one might get in the exams or one might have to face in the real life, right? So here, I'm sure all of you have gone with your gut feeling that this is the area where there is a least use of financial statements, right? There could be used even in resolving labor disputes, but this is the least possible. So that's the right answer. Next one, please. Why is
Sir,
there
it looks
such
like
a
all the answers are.
yeah, so no wonder there is a divided opinion. So the question is actually
Sir, is
who
it
are
competitors the answer?
Yes, the answer is competitors, because while the competitors also have access to the financial statements, they're never the intended users of the financial statements, right? So financial statements, as soon as they are prepared, audited by the audited by the team of auditors, they are immediately pushed onto your website. They are immediately sent out to the SEBI. They are immediately forming a part of the various forms you have to file with the ROC, that is the registrar of companies. In the process, the competitors also get to know the information because these are public documents. The name of the company is a public company. It automatically means that there is a level of transparency. There is a level of free flow of information about a particular company. So that is why competitors are also the users, but they are never the intended users. So the answer is competitors. While the remaining people, directors, employees, customers, all these are intended users. You are targeting them when you are preparing your financial statements. Okay. Next question. Prudence is the right answer. I think we were yet to discuss from here, right? Okay. But anyways, prudence is the right
Yes,
answer.
sir.
All right, I'll stop the polls for the time being because from here onwards, I will take up the poll at a later point. So till now, we have seen that there are various accounting policies that are possible within the accounting framework, which can be chosen by a company. But there are certain broad guidelines as to on what basis these accounting policies needs to be chosen by the company. So what are the considerations? There are three considerations. One is called as prudence, the second is substance over form, and the third is materiality. So what is prudence? Prudence is a concept which says that I'll have to foresee all kinds of future all kinds of possible expenses that the company will have to meet, and if there is an obligation, I will have to record for them. While on one hand this is in relation to the expenses, On the other hand, I should not recognize the revenue unless and until the conditions in relation to accounting standard 9 revenue recognition are satisfied. Okay, or your Ind AS 115 on revenue recognition. So prudence only means try and foresee the expenses, recognize them immediately. But when it comes to incomes, when it comes to revenues, you are not required to immediately recognize them unless and until the conditions as per these standards, depending upon the gap that you're using, are met. The second consideration is substance over form. So what is substance over form? This is something which is one of the fundamental or the core aspects of your gaps like IFRS and Ind AS, right? So what substance over form means is you will have to look at the transaction not on the basis of how it is structured, but on the basis of the substance of the transaction. Say, for example, I am in a business of selling cell phones. For a majority of my customers, I give them a credit period of 30 days within which they have to pay me the money for the cell phones they have purchased from me. But there are a couple of customers or just one customer to whom I am giving a credit period of 1 year. Okay. The majority of customers, I am selling the cell phones to them at 10,000 rupees per unit. Whereas for this particular unique customer, single customer, to whom I am giving a very long period of repayment schedule, I am selling him the same cell phone for 12,000 rupees. So what the substance over form requires me to do is I'll have to dwell deeper into these kind of transactions wherever there is a nexus, right? There is more than what meets the eye here. Just because I am giving a longer repayment period, I am charging more from him. So your Ind AS or IFRS says there is an inbuilt element of financing. I am getting certain interest income, which is nothing but 12,000 minus 10,000. 2,000 rupees is my interest income, which is nothing but instead of giving him 1 year time to pay that 10,000 rupees, if I had taken that 10,000 rupees within the 30 days, just like the normal policy that I have, this 10,000, I have an opportunity to invest somewhere and make more money out of it, because I still have 11 months if I have to compare and say so. But since I have given you time till 12 months, there is an indirect financing element, indirect investment element, right? So that 2,000 rupees will be considered as an interest income. Did you understand? Any queries? So basically,
Can you explain this again, sir?
yeah. So if say, for example, I am selling a particular item for 10,000 rupees as per the normal credit period in my organization, which is 30 days, I will recognize this in the form of a simple journal entry: customer account debit, sales account credit. Correct? Since it's a credit transaction for 30 days. And after 30 days or within that 30 days, whenever the customer pays me, I will recognize the entire amount into bank account as soon as the amount comes. So the sales over here, the amount that is getting recognized in my statement and profit and loss account is 10,000 rupees as sale of cell phone. Okay. But I have one customer to whom I'm actually selling the same cell phone for 12,000 rupees instead of 10,000 rupees, because I am giving him a longer period of time for him to pay me, as long as 1 year. Because I'm giving an additional benefit to him, not only the product, I'm also giving him an additional benefit of an extended time period for him to pay me. I am charging him more. How much am I charging him more? 2,000 rupees. Because had I sold it as a normal transaction, I would have sold the same cell phone to him for 10,000. But just because I'm giving him a higher time limit for him to pay, there is an inherent benefit that goes out to him. Say if you are the person who is buying it for 12 months from me, you are getting a time period of 12 months to repay. Instead of you taking a loan, paying me the money, buying the cell phone upfront, you are directly having this arrangement with me, wherein indirectly I'm also acting as a lender for you, correct? Instead of paying in 1 month, you're paying in 12 months. So that's why when it comes to accounting in my books, I have to recognize 10,000 as sale of cell phone, 10,000 rupees. I'll also have to recognize 2,000 rupees as interest income and not as sales. Customer account debit, 12,000. Sales account credit, 10,000. Interest income credit, 2,000. Did you get me? So that's called as a substance over form. You need to break a particular transaction and identify what is the inherent structure, inherent transaction in a particular transaction. So this is just one example. There are various ways in which substance over form works. I gave you an example of sales. There could be a similar example when it comes to my purchases from the vendors. Right? In such a case, instead of interest income, it becomes interest expense. Instead of booking the entire amount as purchases, I would book certain portion which is over and above the normal price of the cell phone as interest expense. Because instead of taking a loan, I have taken a higher credit period from my vendor, and that 2,000 rupees becomes interest expense, right? So this is the concept of substance over form, which also has to be kept in your mind while choosing various accounting policies. And finally, it is materiality. Say, for example, one of the policy of a company is to capitalize all fixed assets above rupees 5,000. Say, for example, I have purchased a pen drive in my company. Imagine a company like Infosys. Infosys is buying one pen drive. Can you imagine how material this pen drive is to the overall fixed assets or the overall size of the balance sheet of Infosys? It is very, very immaterial, very, very inconsequential. So it could be the policy of Infosys that any asset less than 5,000 or any asset less than 10,000 will be expensed off instead of being capitalized. That could be a policy. So that is a policy based on materiality. Okay. So these are broadly the considerations that one needs to keep in mind before selecting the accounting policies. Okay, so the measurement criteria, at what amount should I recognize a particular item in my books of accounts? There are different amounts, there are different terminologies that one needs to be aware of. Few of these I'm sure you're already familiar, but I'll run you through all the different possibilities. One is called as the historical cost. I purchased a machinery for 50 lakh rupees in the year 2021. I recognize in the books as on the date of the transaction. In the next year, obviously, I'll have to charge certain depreciation for the year that has transpired. And after depreciation, let's assume it's a straight line basis, 10%. 50 lakhs multiplied by 10% is just 5 lakh of depreciation for each year. So now in the subsequent year, the net value of my fixed assets is 45 lakhs. That is 50 lakhs purchase value minus 5 lakhs depreciation is equal to 45 lakhs. So this 45 lakhs is being recognized in my books of accounts. If the policy that you have chosen is to recognize the fixed assets at historical cost subject to depreciation, then this asset will continue to recognize at 45 lakhs itself. But in case you go for a revaluation model, that is, as of 31st March 22, I'll have to appoint an independent professional who is called as a valuer. He will value this particular machinery, and he says, if I sell this machine today, that is as on 31st March 22, in the market, it will fetch me 48 lakh rupees. Then I will recognize the asset in the books at 48 lakh rupees, which is nothing but the market value. The second concept that you can see on your screens, right? Historical cost is nothing but the purchase value. Market value or current cost is nothing but the value as on a subsequent future date, or if we are already in 22, as of 31st March 22, what is the value of that? That is the concept of market value. What is net realizable value? There is a very subtle difference between market value and net realizable value. That difference is net realizable value is always net of selling costs. If I have to sell this machinery, maybe I'll have to do a bit of greasing and oil and paint and things like that. Because of this, I might incur certain expenses like say 1 lakh rupees. So if I was recognizing my asset at 48 lakhs, which is the market value, my net realizable value of that particular machinery is only 47 lakhs, because I have to spend about a lakh or so for various things for me to enable the sale to happen. So that is called as a net realizable value. Okay. Present value of future cash flows. There is a particular concept used in the accounting world, which says that if the assets are, let's take the example of asset only for the time being. If the assets are not capable of generating sufficient revenues, sufficient cash inflows for the company in the future, then the difference between such future income and the present value of the asset is called as an impairment loss. Have you guys gone through these concepts like impairment in your first semester? Anyone?
No, sir.
Okay. For the time being, understand that if the life of an asset, I mean, I do not have okay, let me quickly open an Excel sheet and explain this concept to you so that it will be useful. 1 minute, please. Can you see my Excel sheet?
No, sir.
No, sir.
No, sir.
No,
I'll
sir.
just share again. Yeah. I hope you can see now. Yeah.
Sir, can you be
Sir?
please little louder?
Can you see now?
Yes.
Sir, can you share the PPT with us, sir?
It's already shared on your Quick Force.
Yes, sir. Once. Yes, sir. Done, sir.
There is an asset which you purchased for 10,000 rupees. With the help of this asset, which has a life of 3 years, you can generate sales of, let's say, 3,000 in the first year, 4,000 in the second year, and 3,000 again in the third year. Okay, these are all the future monies that I will be getting. At the end of third year, I'll have to sell this asset, which is worth 10,000 at the time of buying, for 0 rupees. Let's assume there is no scrap value, there is no resale value. Okay, if forgetting the time value of money, keep the time value of money for the time being aside, 10,000 rupees is what I have invested. I have recovered 3,000 in the first year, 4,000 in the second year, 3,000 in the third year. So effectively, I have been able to break even. Whatever I have spent, I have realized in total. Are you with me till now?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yeah. So let's
Yes,
take the concept of present value over here. All of you know that 1 rupee in your hand today and 1 rupee in your hand after 1 year is not of the same value. Thanks to various economic concepts like inflation, depreciation in the value of money, etc., there is a certain difference between 1 rupee as of today and 1 rupee at the end of 1 year. obviously 1 rupee which is in my hand today is valued much more than 1 rupee that you might get at the end of the first year. Do you agree with me?
Yes, sir.
Yes, sir.
Yes,
1
sir.
rupee right now
Yes, sir.
I already have in my pocket is much more valuable than the 1 rupee that I get after 1 year. So similarly, the 3,000 rupees which I get at the end of first year, if I have to see what is the value of that if I get it today itself, then that is called as the method of discounting. It could be the case that, let's assume for the time being, the discounting rate is 10%. In other words, how did we arrive at this 10%? It could be the inflation rate, it could be the GDP growth rate, it could be a mix of several factors. Again, not a subject matter of discussion for today. Let's assume it is 10% is a discounting factor. So on the basis of that, 3,000 rupees at the end of first year is only equal to 2,700 today. Okay. Are you guys with me?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Sir, once can you repeat, sir?
Yeah, just a minute. Okay, so what I'm saying is, continuing the same example of 1 rupee in my hand
So
today.
can you be please louder?
1 rupee in my hand today compared to 1 rupee in my hand after 1 year. 1 rupee in my hand today is higher. Until this point, all of you have understood, right?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Similarly, if a person gives you an option to pay you 3,000 rupees today or pay you 3,000 rupees in the future, which one will you choose?
So today, sir.
Today.
Today.
Absolutely. That means the 3,000 rupees value today is higher. But if you ask the same person, I will not be able to wait till the end of 12 months. You pay me today itself. Then that person will say the discounting factor is 10%. Then I will pay you only 2,727 today. Because that is the value of 3,000 today. My obligation to pay you 3,000 is at the end of the first year. But I am paying you the 3,000 today itself. That is why I will not pay you the whole 3,000. I'll pay you only 2,700, which is nothing but the value of 3,000 today instead of taking it at the end of the first year. Should I explain again or are we clear? If you have any questions in relation to how this 10% is arrived at, please park them aside. I will discuss that at a later point. Let's understand the
Sir,
concept of
actually,
present
my
value.
doubt is this 2,700, sir.
I'm sorry, that was just a approximate figure. I actually put the formula over here. So how do we arrive at is 3,000 rupees divided by 1 plus discount rate to the power of number of years. It's 1 year, right?
So we have taken 1 year, yes, sir.
So to the power of 1.
Yes, sir.
Okay. So similarly, standing today, if I'm supposed to get 4,000 rupees at the end of second year, okay, 4,000 rupees at the end of second year, then that is equivalent to 3,003. Yeah. If I put the formula, it is 3,306 today.
Yes, sir.
You can also look at it this way. If I open
Sir, nothing but 4,000 into 10% to the power of 2.
Yeah, 1 plus 10%.
1 plus, yes, sir.
Right. So similarly, what I'm getting at the end of third year, if I want to get it today itself, 3,000 will be equivalent to 2,254. And as we proceed forward, the value just keeps reducing. Understood?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. it's time for attendance of your second session. I'll just give you a minute. The same exercise again. Go back to your quick force, put the attendance and come back, please. I hope all of you have done.
No, sir. So I'm facing some issues, sir.
Okay. Okay, I'll just give you 30 more seconds, please. I think many of you are able to do it, so the issue could be at your end.
Yes, sir. I've mailed also. The morning session also I couldn't do it. So I've
Can you
mailed.
just take it up with the concerned technical person? I'm not really sure. Okay, we'll just discuss this at the end of the session. If you still have a problem with the attendance, I'll just see whom you have to coordinate with. Okay, so coming back to the concepts. So you understood that 3,000, which you are supposed to receive at the end of 1 year, is only equal to 2,700 today. And 3,000, which you are supposed to receive at the end of the third year, is equivalent to 2,200 today. Similarly, 3,300, correct? If I add all these three, then it comes to only 8,287, correct? Are you with me?
Yes, sir.
Yes, sir.
So if I am a prudent, logical businessman, I will not be ready to invest 10,000 rupees today, which is capable of generating only 8,200, because ultimately I'm making a loss of 1,700. Am I clear? I'll repeat. I am spending 10,000 rupees to buy this asset, which was capable of generating 10,000 rupees over a period of 3 years. But if I look at the cash outflow today, which is 10,000 rupees, cash inflow today, which is the present value, is 8,000.
Yes.
It doesn't make any sense for me because I'm making a loss. Am I right? Instead of investing in this asset, let's assume I put it in a fixed deposit, I'll at least get some 5-6% of interest, right?
Yes, sir.
Yes, sir.
So instead of me doing this business, I would rather put it in some risk-free investments. For all you know, in doing this business, getting 3,000, 4,000, there is an element of risk also, correct?
Yes, sir.
Upon that, you are not even assured of returns. So this particular 8,287 that we have calculated is nothing but the present value of future cash flows. 1 minute.
Sir,
Yes, sir.
so that 10,000 was the asset value after 3 years.
10,000 is the amount that you are spending today to purchase the asset, with the help of which you are able to generate income of 3,000 at the end of first year, 4,000 at the end of second year, and again 3,000 at the end of the useful life of the asset, which is 3 years. At the end of 3 years, another 3,000.
Okay, sir.
Are you with me?
Yes,
So
sir.
the expected is 3,000, we are getting 8,200 change.
Correct. Yeah, whatever that could be. Yeah.
Yes.
No, the idea is to drive the concept clear that the present value of some cash flows in the future will always be lower than what they are in the future.
Yes, sir.
So that is the concept called as present value of future cash flows. In my case, future cash flows were 3,000, 4,000 and 3,000. The present value of all of them put together is 8,000. So in accounting terminology, if a company is having an asset like this, which in simple words, I would call it as a waste asset, because it is not generating any profit for me. In fact, it is giving me a loss. The difference between that 10,000 and the present value of future cash flows, which came to around 1,700 in our example, is nothing but the impairment loss of the asset. That is the terminology. What is the impairment loss? I will repeat. I have an asset in the books on my balance sheet, but it is capable of generating a value, present value, which is much lower than what it is there in the balance sheet. In the balance sheet, it is at 10,000 rupees. The difference of 1,700 is called as an impairment loss. And that loss I will have to recognize in my books immediately, is what the accounting standard says. And how do I recognize this loss? What does the golden rules of accounting say? Nominal account, debit all losses and expenses. So I'm going to debit impairment loss, which is a statement of profit and loss account item. Debit impairment loss, and I will credit my fixed assets, because I am supposed to reduce the value of my fixed asset from 10,000 to 8,700. Are we clear?
Yes, sir.
Yes, sir.
Yes, sir.
Yeah. Can we move forward?
Yes, sir.
Sure. We'll take a deeper dive into the contents of financial statements, starting with balance sheet. I think from here onwards, I will open one annual report and we will start looking into a real life case. This is sort of theory. What is there on your PPT is all theory. How many more minutes are left for the class to end? Can someone tell me?
40 minutes.
Okay, we have 40 minutes, right? Okay, so this PPT anyways has already been shared with all of you. Let me see if I can toggle between an annual report and this one. Just a minute.
Sir, one annual report you have shared in the...
That's right. So that's what we will be looking at today.
Sir, this is practical approach or theoretical approach, sir, this subject?
This is going to be completely practical with certain theory. But today's session is mostly theory, because these are few fundamental things, right? Like I mentioned, most of these concepts are in the form of refreshing your memory. And these concepts are important for you to understand the practical aspects.
Okay, sir.
Okay.
So we'll be doing in Excel only maximum.
Sorry? Yeah, it will be either Excel, it will be either annual reports, it will be case studies.
Yes.
So it's going to be primarily numerical numbers.
Yes.
Sure. 1 minute. Can you see my screen?
Yes, sir.
Yes, sir.
Now I'm able to alt tab. You're able to see the PPT also, right?
Yes, sir.
Yes, sir.
Only PPT we can see.
Now I think you can see the annual report.
Apollo.
Yes. So what we are going to look at now is the annual report of the financial year 2019-20 of Apollo Tyres. The reason for picking up this particular company is it is fairly simple when it comes to its business. The business of Apollo Tyres, all of you know, is that it is into manufacture of as well as sale of tires. Correct? Can you see the screen? Should I zoom?
Yes, sir.
Yes, sir.
Yes, sir, we can see.
Yeah, just a minute. Yeah, let's just zoom in a bit more. Yeah, so I've selected Apollo Tyres primarily because this is a fairly straightforward business. not multiple sources of revenue. They are only in the business of manufacturing and selling of tires, and they have their operations in India and a couple of outside India locations as well. So let us briefly look into the contents of, I think I'll have to zoom out. Can you see the content page? Can you all see the content page?
Yes,
Yes,
sir.
sir.
Okay. So there are 6 broad headings in which the annual report has been categorized. Okay. The first is called as the corporate fact sheet, wherein they try to give information about certain KPIs, key performance indicators. We will see what kind of indicators that Apollo wants to disclose to the users of financial statements, whatever they feel are certain targets that they have achieved, certain improvements that they have made compared to previous year. All these are key performance indicators, right? As the name itself says, these information in very limited number of words are capable of explaining how they have impacted their performance positively or negatively. Primarily, it is the positive things that they discuss in this particular section. The second heading is called as the leadership and governance. We've already discussed a lot about the management capability. How capable is the management is something which is directly attributable to how well the business is doing. So who is at the helm of affairs of the company? Who are all the board of directors? Who are all the major senior officials or employees in the organization? All this will be discussed in the leadership and governance part of the annual report. The third heading is the performance and progress. So this particular section about talks about a host of in detail elements, in detail business performance numbers other than the financial statements. Mind you, financial statements, still we have not come to that particular element of the annual report. This particular thing is something which is open to the company's management to include whatever they feel is important. It could be things about various resources that they use, like the human capital, the value capital, it could be the sustainability elements. It could be how they are trying to do more of exports, and they are trying to generate employment opportunities, how they are trying to conserve energy. It could be various things depending upon business to business, right? So all these things will be discussed in this particular heading, including, say, key performance indicators. At a bird's eye view level, that was already included in corporate fact sheet, but in a detailed manner, it will be further included in this particular category. Similarly, what is the business model? What is the revenue model that they have? We will see as we proceed forward. The next one is called as the management discussion and analysis, which we call it as MD&A. MD&A is something which is mandated by SEBI to be a mandatory inclusion in the financial statements of listed companies through a particular set of regulations called as the ICDR regulations. There are various regulations that have been brought out by under the Companies Act through the SEBI. So all these, one of the regulations mandate a listed company to primarily disclose something called as management discussion and analysis, wherein certain elements will have to be discussed about, particularly in that particular order. Okay. The fifth one is the most important element, which is the financial statements, which comprises of the board's report on the financial statements, the auditor's report on the financial statements, along with the necessary corporate governance reports, which are mandatory again under the Companies Act and SEBI. Okay, so all these comprise the financial statements in respect to this particular company. Of course, your corporate governance report is not a financial statement, but primarily the statutory reports comprises of your financial statements. And of course, split between two different headings, that is standalone and consolidated financial statements. Generally, the fifth heading and sixth heading are generally consolidated. In this particular scenario, they have bifurcated them again, but these two will have to be read in tandem, because auditors report, etc. Everything will have to be considered along with the financial statements. You cannot read in a standalone basis. So these two are together. Any questions till now, or can we go down? Can we start looking into the annual report?
We can do, sir.
Yeah. Tell me something, was annual return a part of your syllabus in semester 1? Did you guys have a look into these things or no? That will also help me understand how in detail I have to go.
So,
Sorry?
no, sir, we didn't had a look into annual
Didn't have
reports.
annual returns, sir.
You never had as a
We
part?
looked it into in accounts for manager once ma'am had shown us and explained.
How many annual returns, how many annual reports have you seen as a part of that curriculum?
So maybe 1 or 2.
Achha, okay, sure. All right. So first heading was corporate fact sheet, right? So in this particular heading, you will look into the vision, values, mission statement of the company, and how they are able to make a difference. They have served 100+ countries. They are located in 7 locations across the globe. Whatever makes them, stand out compared to their competitors, like say Apollo, etc., etc. I'm sorry, MRF, or it could be Continental Tires, it could be Pirelli, etc., etc. Across the globe, they would want to showcase how they are leading in this particular industry, right? And they also talk about the different brands that they have. Their primary brand is Apollo, but they also have another brand which is called as Vredenstein. That is also a brand that they sell. These are the various key performance indicators. What performance is it? I have sold 160 billion rupees. That's my revenue. That's a key performance indicator. Capital expenditure, I have spent so much. I've had a profit of 4 billion, right? So which is roughly, what is it, like 0.25% of my revenue, right? And this is my earnings before interest, tax, depreciation, and amortization. This is net profit after considering all interest, tax, depreciation, and amortization. But this is before these 3 elements. I'll tell you why this particular amount is required. For the time being, understand that there are various versions of net profit, which is on the basis of adding certain expenses, subtracting certain expenses, not considering certain expenses. There are various components. We will get into it in our future sessions, but for the time being, understand EBITDA is a very important financial parameter. Talking about the CSR, they have mentioned about so many things like recycling, etc. Talking about how they are a people company, how many employees they have. Now they move into the leadership and governance, where there is a keynote address by the chairman, then there is vice chairman, and then you have the board of directors. Okay, so a host of management related information is there. Now this is the third heading. Like I said before, in the third heading, the key performance indicators will be shown in a much detailed manner. We already saw that the sales were 160 in the key performance indicators, but here they have given a comparison with the previous years. You can see that there is a increase as well as a decrease in the sales year on year compared to financial year ending 19, financial year ending 20. There is a decrease in the sales. Similarly, there is a decrease in the profit. Similarly, there is also a decrease in the EBITDA. Since you're already aware about various ratios, various important ratios like debt equity ratio and your current ratio.
Profit earning ratio.
Absolutely. Ratios, net margin ratio, gross margin ratios, liquidity, solvency ratios. There are multiple ratios, right? All of you are already aware about it. So these also form a part of your KPI, key performance indicators. So year on year comparison is what has been given on Apollo Tyres annual report. You have return on equity. Interesting. So what is return on equity? If I'm able to earn 1 rupee for every 10 rupees of capital invested, that means I'm earning 10% return, correct? Similarly, they are earning 4.8% return on the equity. Then they have given certain segmentation information, revenue segmentation by geography, because they are present in EMEA, that is Asia regions, as well as Europe regions. So they seem to be highly present in the Asia regions. Revenue segment by customers. So they have different categories of revenue segmentation. So that also in the form of a chart they have shown. Then different categories of where their tires are used. So majority of their tires are used in passenger vehicles and trucks, while the remaining 3 are low in terms of numbers. They also have given how the price fluctuations of their major raw materials impact them. So in a tire manufacturing entity, your major raw materials are rubber and chemicals, including certain elements of crude oil, correct? So they find rubber, crude oil as the major items. And obviously these are internationally benchmarked when it comes to their prices. Of course, oil, needless to say, all of you are aware, it is internationally benchmarked. So how their movement will impact the profit of a tire manufacturing company is something which is disclosed over here, the movement of prices. Then they talk about the various capitals. So they talk about the natural capital, where they, talk about the environment related things, human capital, social and relationship capital, and then they have intellectual capital. Intellectual capital is to do with R&D. What kind of research I'm doing? How am I trying to reduce the usage of rubber or non-renewable energies? Manufactured capital is in terms of how much of a value generation have I been able to do? How am I even what percentage of the GDP at a very, very broad level, macroeconomics, I can even speak of, right? Then financial capital. Financial capital is about how I have been able to generate returns for my investors and what is their value creation mechanism. So this is all about at a very, very broad level, how they have been, caring about the employees' requirements, communities' requirements, customer requirements, etc. Okay. So, and then again, each of these capitals there will be a deeper dive, whatever we saw, right? Natural capital, human capital, social capital, all of this, they have gone ahead to explain how they have tied up with the various people, communities, society, etc. I'm not going to dwell upon all of these. Of course, I have put this on quick force. If you're interested in these things, you can read at your free time and always get back to me with questions. I'll be more than glad to answer them. Let's scroll down a bit faster. The various events that they have conducted, various CSR activities that they have conducted, how they have kept the customers at the forefront, how many customer redressal queries, complaints have been answered, how they have able to create value for the stakeholders. Each city-wise, Chennai, Kalamassery, or I think these are all the locations where they have their manufacturing units, how they are working towards protection of the environment. Okay, so this is where we come to the next section called as the management discussion and analysis. Like I mentioned, this is a mandatory part as required by SEBI. So under this part, they again discuss about certain broad level economics, unit economics, such as how the industry for tire segment has been doing. What percentage of the tire industry or tire market am I occupying? It could be 10% of the Indian market. It could be 2% of the global market, things like that. SWOT analysis, yet another important part of the Mdna, where my strengths lie, where my threats lie, and if I have certain threats and challenges, how have I been able to address them? It cannot be a case that every company will only have strengths and opportunities. They will also have a bunch of challenges and threats, right? So this is a space where they discuss about all these things. Again, revenue wise, geographical location wise, etc. As a part of the Mdna, there is certain financial performance numbers that they will be discussing. which can also be correlated to our income statement and balance sheet. Okay, so this is generally being given in a slightly different format. We can more or less call it as a repetition of the information, but this is a mandatory part of the SEBI's inclusion. So that's why that's included, so to say. Okay, so this is where the board's report starts. So board's report, in other words, the board of directors report is a report through which the directors convey their opinion on certain mandatory aspects as per the Companies Act, as to how the performance has been, and if there are any audit observations, what are their opinions on that. Okay, and what kind of information has been disclosed in the financial statements. As you can see, it's about operations, it's about raw materials consumed, it's about dividends that have been given during the year. It's about how many meetings of the board of directors have been taken place, how many independent directors are there and how they are participating, what is the remuneration of the directors. You would know recently the remuneration of the Zerodha founder was in the news, right? So similarly, the various other details are, mandatory part of the financial statements, especially the board of directors report. They also talk about who are the auditors, who are the secretarial auditors who have been appointed to look into the Companies Act related things, and what kind of mechanisms that they have in the organization. You must have heard about the insider whistleblower mechanism. There are many cases, even companies like Facebook, they have got some gender discrimination complaints being raised by the employees. Even the smallest company, you can imagine how many more complaints it would be there when a company like Google or Facebook can face these kind of things. So there is something called as a vigil mechanism. So there is something called as insider trading. So what happens in listed companies is, just before the results of the company are announced, the insider people, like employees who have access to this information before it becomes public, because this information is very sensitive for the market. If the company has done really well, and if the results are supposed to come out tomorrow, today I can buy the shares of the company because I am privileged to have certain information. And tomorrow when the price increases, I should be sell it and make a profit. So that's called as insider trading, which is absolutely prohibited. One cannot take dominance, or one cannot misutilize the kind of position or information that they have. So though, in order to avoid these kind of situations in a company, there are various mechanisms or various checks and balances that are put forth in a company. All right, and they talk about related party transactions. If I have purchased something from my subsidiary company, be it in India or outside India, what is that? If I have taken a loan from the directors, how much is that? So all these people are related parties. Any kind of transactions with related parties will have to be disclosed. Risk management, etc., etc. Again, secretarial audit report, not a subject matter for our discussion for the time being. Only understand that this is a mandatory report supposed to be given by a company secretary, which is a requirement under the Companies Act, along with the various rules that have been formed under the Companies Act, where a company secretary will have to comment upon various compliances with the Companies Act and related SEBI compliances. Next, we have the CSR report. Mind you, CSR is a mandatory requirement if there is a particular threshold has been defined under the Companies Act. If your turnover or if your profits are higher than a particular turnover, then you will have to contribute 5% of your profits into CSR activities, post-tax profits into CSR activities. So this CSR report becomes all the more important because this is a way of giving back to the society. This report talks about how the money has been spent. So as you can see over here, there are various projects and awareness things that they have spent the money on. Tree plantation, general health, economic upliftment, etc. So this is a huge report on your CSR. Okay, foreign exchange earnings, conservation of energy. This again is a mandatory part which is required to be disclosed upon by the Companies Act. So this is also disclosed in detail. Annual return. Mind you, the entire document that we are seeing now is called as the annual report, whereas annual return is nothing but a summary of various operations of a business that I have to upload into the ROC, that is MCA. Okay, this is the format for that. Please stop me if you have any doubts. I hope you are all with me and not sleeping.
Yes, sir.
Yes, sir, we are here.
Yes, sir.
Thank
Yes,
you.
sir.
Okay. This is the shareholding details. Dividend distribution policy, they have a policy on how it has to be done. Like there should be necessary approvals. First of all, it should be proposed by the board of directors, and then it has to be approved by the shareholders. CEO, CFO certification, these people who are at the helm of affairs of a company have additional responsibilities to report on certain specific business related and performance related responsibilities. So that is their report. Next, we come to the independent auditors report. This is where the statutory auditor, a chartered accountant appointed by the company, will have to audit the company. Like I said, it could be a clean report, or it could have certain observations. It could be negative or just information purposes kind of observations. So here it looks like they have given a clean report other than one emphasis of matter. So the emphasis of matter, what does it say? We draw your attention to so and so note, which says that due to the uncertainties related to the COVID-19 pandemic outbreak, there is certain impact on the balance sheet, and these uncertainties significantly impact the future performance of the organization. So here, this is a very broad statement, right? Obviously, auditors are not gods. They will not know what will happen in the future. So they are trying to alert the users of the financial statements that this is also one of the company which has been impacted by the COVID-19 pandemic, and the future performance because of this kind of a pandemic can be impacted, right? So to the extent that some numbers can be put around this, the management can do it in the financial statements. And every listed company is supposed to report on certain key or important matters called as the key audit matters. We call it as KAM. We call it as the CAMs, wherein the auditor will have to identify, depending upon the risk profile of a company, what are the key areas, very important areas, and how we have adopted independent verification procedures to address that risk. Okay, so since we are talking about Apollo Tires, they are talking about certain sales related obligations and the related provisions. What could they be? The auditors find it that certain obligations which might come in the future, it could be in the form of warranty, it could be in the form of damages that the company will have to reimburse in relation to quality issue of the tires if it is a part of the agreement. So these kind of things, the auditor perceives it to be material because there is an element of uncertainty. You will never know. Today, if you buy a pair of trousers on Myntra, within 5 minutes, you even return it back saying there is some quality issue, size issue, etc. Just imagine, as the size of the company, the size of the product that we are talking about is much bigger, there are higher chances when the kind of contract that is there between the company and the customer allow for certain warranties. Okay, it could be a automobile manufacturing company, it could be a air conditioner or a refrigerator that you have purchased. Refrigerator manufacturing companies like Walters, etc., they'll have various contracts with the agreements which will give them certain warranties for 2 years, 3 years, etc. Right? So there is an element of uncertainty, there is an element of risk. It could be the case that I will end up paying 1 crore rupees this year, and next year it could be the case that I end up paying 10 crore rupees towards warranties. So one needs to estimate these kind of warranties and how that estimation is done. It could be on the basis of past trends. In the past, this is how I am paying money for the warranties, for the damage claims, for the quality issues. Accordingly, I will make a provision for the future. So something like that. Okay, so this they have identified as a key audit matter. And on the right side, you can see what audit procedures the auditor has adopted to address these issues. So similarly, there are various other key audit matters, etc. Let us jump into the subject matter again. The very important part of your financial statements is the balance sheet. Can anyone tell me what time are we supposed to end the session?
11:40.
11:40, sir.
Okay, all right. All right. So the first and foremost important part of your financial statements is the balance sheet. So balance sheet, again, all of you have looked into it in your first semester subject also, that it comprises of assets, liabilities, and equity. So what are all the assets? The assets are primarily categorized into current assets and non-current assets. What are current assets? Those assets which will be converted into money or money's worth within one operating cycle. What is operating cycle? Most of the times, operating cycle is considered as 1 year itself. In other words, if you ask me what is the meaning of operating cycle, it means the time taken to convert a raw material into sale. That means raw material goes through production, production goes through completion, finished goods go into marketing for the purpose of sale, and then the sale actually takes place. This entire cycle, let's assume, takes 1 year. Then my current and non-current bifurcation in the balance sheet has to be done on the basis of 1 year as a benchmark. Anything which will get converted into cash or cash equivalent within 1 year will be considered as current. It could be an asset or a liability. Otherwise, it will be called as a non-current asset or a non-current liability. So it's obvious that we have property, plant, and equipment over here, which is obviously with the intention of holding it for a longer period. Work in progress. I am building an additional manufacturing premises, and it is still under construction as of the balance sheet date. So that is work in progress. Intangible assets. Intangible assets are something which you cannot see. You can only get the benefit out of these kind of assets. It could be, I have purchased a brand. I have got some internally generated goodwill. Okay, these are all the various examples. Every day you in the real life scenario, you find multiple people taking over multiple companies. Few years back, Google took over YouTube. Few years back, Facebook took over WhatsApp. And in the process, the amount that these people pay to acquire a particular business is not only for the tangible assets that the company has, but also for various intangibles, like the brand value, like the goodwill that that particular has. Is there a question? So these kind of assets will be disclosed under intangible assets. Then you have investments and various other financial assets. So what are financial assets? Financial assets are those where there is a contractual transaction with certain parties, and these contracts give you a right to get them in the form of money. So investments, you have a right to get them back in the form of money, right? So that's called as a financial asset. Trade receivables, you can recover that in the form of money, right? So that's a financial asset. What are non-financial assets? Inventory is a non-financial asset, because you do not know at what value you can recover your inventory. You can sell your 100 rupees worth of trousers for 150 rupees also, or if there is no demand, you can sell it for 90 rupees also. So there is no contractual right to a particular amount. That's why inventory is a non-financial asset. But in case of a trade receivable, more often than not, if I am supposed to get 100 rupees from my customer, he has to pay me 100 rupees. There is no question of 150 rupees or 90 rupees, right? Unless he's a bad debtor, or if there is some negotiation, etc., which is again a secondary thing. But at the outset, trade receivables are fixed amounts of money that I can realize in. Next, we will look at equity and liabilities. Okay, so equity and liabilities primarily talk about all the sources of funding for an organization. Equity share capital are the primary owners of an organization. There are various other sources of financing like preference share capital, debentures. Again, there are convertible debentures, non-convertible debentures, convertible preference shares, etc., which we will see again in the future. For the time being, understand there are different kinds of sources of funds, that is equity, and there are various liabilities. Again, here the concept remains the same. Financial liabilities, if I am supposed to pay 100 rupees, I have to pay 100 rupees. That's why borrowings are considered as financial liabilities. Provisions are non-financial. We took an example, we can take an example of, I have entered into a contract with a particular person where the liability for me to pay is dependent upon how much I buy from him in the future, or how much I buy on a day-to-day basis. So I do not know if the amount that I have to pay is exactly 100, or it could be 95, or it could be 105. So those kind of amounts are put under provisions. Okay, you must have already gone through the concept of a difference between a liability and a provision and a contingent liability, right? So all provisions come over here. Contingent liability, like I discussed, it is an off balance sheet item. Next is, don't worry if you think I'm rushing through a few of these points, because we will be looking at financial statements of different kinds of companies as a part of our course curriculum. So if you have any doubts, you are more than free to ask doubts, but I will try to explain these concepts specific to the industry in relation to each example that we take up. So this logic is the same over here. Non-current and current liabilities depends upon the operating cycle. Here, generally, it will be considered as 1 year. Needless to say, the balance sheet has to match, because the sources of funds and application of the funds has to be the same. And if the balance sheet is not matching, it is obvious that there is either an error or there is some mistake or some loopholes in the way the accounting books have been maintained. This is the statement of profit and loss. Why do we call it as a statement of profit and loss and not profit or loss? Can anyone tell me? Because we either have
Sir, it
profit.
can be profit or it can be loss.
Yeah, so why is it not called as profit or loss? And why is it called and?
Sir,
Because it includes both.
at the
You
time
may
when
get both profits and loss.
How is it possible? I will either get a profit or a loss.
So that is the collective profit and loss that we're talking about. But when we talk about these specific subheadings, like if you're talking about only revenue from operations, we can see that there can be either profit or loss. But collectively, the entire statement includes both. So that's
Absolutely right explanation. So
Sir,
that
the
is
final, yeah, the final amount is net profit or net loss.
That's
The
right.
accounting,
That's right. The word here used is net and gross, right? So they are not in relation to individual product. They are in relation to sum total of all the tires that I have sold, irrespective of which geography, irrespective of whether it is a tractor tire or otherwise, right? So that's why it's called profit and loss. And also one more reason is the previous year could be a loss, this year could be a profit, right? So there are different variations of profit and loss in the same financial statements. Okay, so in the financial statements, fairly self-explanatory. Revenue from operations like sales and other operating income. So sales are primarily your revenue earning operations. In this case, all the sales of tires will be disclosed over here. There are various other incomes which are not directly related to sales, which are either categorized as other operating income or other income. It could be, say, sale of scrap. It could be, say, sale of certain byproducts, etc. Other income could be, say, because of your substance over form. We discussed, right? Substance over form, 10,000, 12,000, 12 months credit period, 2,000 rupees. Where will I disclose? Interest income, right? That will go under other income, because that's not the intention of running the business, right? My intention is to sell the tire, not the intention of giving a big amount of credit period, and that difference is my source of earning the revenue. Then I will have to put it under sales and services only. But that is just a one-off transaction, then it will come under other income. Cost of materials consumed, very important thing. This is only in relation to the products that have been sold, because in case it is in case it is certain items which have not yet been sold, then that will be a part of inventory which is in your balance sheet. It is an asset for you. But the moment a cell phone is sold, the related manufacturing cost, okay, in this case tire, the related manufacturing cost, the related directly attributable expenses, all of it will be categorized under cost of materials consumed. Mind you, cost of materials consumed is primarily raw materials, consumables, and direct labor sometimes. Okay, cost of materials consumed. Purchase of stock in trade. Cost of materials consumed is in relation to a manufacturing process, whereas purchase of stock in trade is a case where I just buy and sell. There could be certain items in a tire industry, tire company, which I am just buying and selling. I am not making any value addition in the process. I am just buying and selling it as it is. And those kind of sales are also included in this sales, but the related purchases are separately shown called as purchase of stock in trade. Changes in inventories, again, opening inventory will generally get converted into sales. It depends upon the kind of formula that you're using, which we discussed, FIFO, weighted average. Depending on that, this is purely a mathematical formula. Then you have various expenses like employee benefits, finance cost, if I have any loan, temporary overdrafts, cash credit arrangements, etc. Depreciation, one of the major non-cash expenditure. There is no outflow of money, but this is more about creating the matching concept. If I have an asset and I have used 10% of the asset in the 10 years of useful life, in order to ensure a matching concept, I recognize that 10% as an expenditure, which we call it as depreciation. Amortization is a word which is specifically used in relation to intangible assets. Say, for example, I have purchased a patent right. I'm a pharmaceutical company, for example. I have purchased a patent right from another drug manufacturer, for which for 10 years, I will be able to use that patent right and manufacture certain medicines. I have paid 10 lakh rupees for this. The life of this patent is 10 years. So every year, 1 lakh rupees, I will, if I'm using a straight line method, there could be various other methods, but if I'm using a straight line method, every year 1 lakh I have to debit to the P&L, called as amortization expenses. Then we have a host of other expenses where, as you can see, there is a reference to particular note numbers over here. If you see these notes, you will find that there are various breakups for these items. And after subtracting the expenses from the total income, you arrive at something called as a profit before exceptional items. So what are exceptional items? There could be certain transactions which, because of their sheer volume or the sheer nature of the transaction, depending upon the judgment of the management and the consultation of the auditors, certain items will be carved and kept as exceptional items. So that has to be disclosed separately. As you can see, in this year, there is no exceptional item. However, in the previous year, there has been an exceptional item. So there will be a certain note on this. I'll just see and tell you what exactly this 2000 million was towards. That expenditure has been shown separately instead of showing under other expenses. It has been shown separately. So the profit after tax, after exceptional items over here is coming to 8,000 million. Then there is tax, current tax and deferred tax. Deferred tax is again accounting adjustment, which is required to be calculated in a particular manner in order to ensure that the timing differences between accounting records and tax records are matched. For the time being, again, just understand it is an accounting method of doing it. When time comes, I will explain to you. Then there is something called as other comprehensive income. Very important again. So basically your statement of profit and loss can also be called as an income statement, can also be called as a comprehensive income. As a part of this, then there is something called as other comprehensive income. So what Ind AS and IFRS says is there are certain aspects or certain elements in your financial statements which if added into the main P&L account will result in a lot of fluctuations, lot of instability. It could be because of mark to market gains. Like I have certain investments. I'm not yet sold it. As on the balance sheet date, the market value has gone up because the stock market has gone up. The value of the investments is very high. I've not yet realized them, but there could be certain situations where I'm supposed to recognize them at mark to market, right? If it is a short-term investment, I'm supposed to recognize the market gains or losses, and such amounts, since they are not yet realized, will have to be recognized under a separate heading called as the other comprehensive income. This is one of the examples, but there are certain 8 to 9 set number of transactions that always come under other comprehensive income. We will again see them as we proceed forward in our subsequent sessions. So this is the statement of changes in equity. So in this statement, you will find that there are various changes in the equity that happens, primarily because of the operations during the year. It could be because of addition of profits, that is retained earnings. It could be because of further issue of share capital at a premium, where the difference will be classified as securities premium. It could be items of other comprehensive income, because these items sometimes will directly go into the balance sheet without coming into the P&L. So all these transactions will have to be disclosed over here. Okay. Then we have the cash flow statement. Cash flow statement primarily is a statement which bridges the gap between the actual profits that you have earned and the profits that has been disclosed in your statement of profit and loss. Why is that? Because my statement of profit and loss is prepared on accrual basis. It is not prepared on cash basis. If I am supposed to get some money for a transaction for a sale that I have made today, I have sold say 10,000 units of tires to say Kia Motors. I am yet to receive the money. I have not yet received the money. So my bank statement will be lower, whereas my sales is higher. So my profit will be showing as say 1 crore rupees, but in my bank statement or other assets, I'll have only 10 lakh rupees as my bank balance, or inventory is another 20 lakhs. All put together also, I will not be able to identify where that 1 lakh is. I'm sorry, 1 crore is, right? So that is when a statement called as the cash flow statement would be very, very helpful for you to analyze.
Sir, we have one more class.
Sure.
At 11:40.
Okay, so then what we will do is from here, we will continue in the next class. We are left with the cash flow statement. And that's all, notes to accounts. Nothing else is left for today's discussion anyways. So quickly coming back to the PowerPoint presentation. Balance sheet we have discussed, statement and profit and loss we've discussed, other comprehensive we have discussed, cash flow I will continue in the next class, changes in equity we have discussed, notes to accounts at a very broad level we have discussed. So this was the last slide. So just remind me, cash flow and notes to accounts also to a certain extent we will start with in the next class. Okay. So if there are any questions, feel free to put them across to me. And recordings of the session, someone is asking, yes, sir, it will be available to you. I don't know how quickly it will be available, but I think there will be at least some 24 to 48 hours before they are visible on your pages. All right. So this is where we conclude the very first session, first two sessions, first day of this particular subject, financial statement analysis. Thank you, everyone.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.